What if I told you that the way you calculate a product's cost could mean the difference between its success and, well, its failure? It sounds a little dramatic, I know, but it's a reality that businesses face every single day. We're about to dig into the costing methods every manager really needs to understand because, believe me, getting this wrong can lead you to scrap your most promising products without even knowing it.
So let's start with this question. It seems so simple, right? How much does this thing cost to make? But the answer can, and often does, change dramatically depending on the accounting lens you're looking through. And that's absolutely crucial because the method you choose has a direct impact on which products you decide to champion and which ones, well, you decide to cut.
So here's our game plan. First, we'll cover the basics of what a cost even is. Then we'll talk about setting standards and building flexible budgets. And that all leads up to the main event, the face-off between two really powerful but very different costing philosophies. By the end of this, you'll know exactly which tool to pull from your toolkit and, just as importantly, when to use it. All right, let's start at square one. Why do we even bother with all this fuss about the cost of a single item? I mean, why does it matter so much? Well, it really boils down to 4 critical reasons. First, you need it for the accountants, for valuing your inventory and creating financial statements that are actually accurate. But for managers like you, it gets even more important. It helps you set your prices. You can't price something for a profit if you don't really know what it costs you. And maybe most importantly, it guides your biggest decisions. You know, which products get your time and money, and which ones maybe get cut. Now, to control your costs, you first need a target to aim for, right? A benchmark. And that's where something called standard costing comes in. Think of it as the blueprint for what your product should cost. So a standard cost is basically that target. It's a preset idea of what a product is supposed to cost under normal, efficient conditions. It's like having the perfect recipe. Businesses use it for all sorts of things, planning their budgets, seeing how well they're performing, and generally just keeping costs in check. You want to know a perfect real-world example of this? Just think about McDonald's. Every single Big Mac has a very precise, pre-measured amount of sauce and exactly 2 pickles. Not 1, not 3, but 2. That is a standard in action. It's what lets a global giant control both their costs and their quality with just incredible precision. But here's the thing, not all standards are the same. You've got ideal standards, which assume absolute, total perfection. No waste, no breaks, no mistakes. As you can imagine, these can be pretty demoralizing for staff because they're basically impossible to hit. The most common type is the attainable standard. This one's realistic. It allows for normal things like breaks and a little bit of waste. It's challenging, but it's motivating. Then you have current standards, which just reflect how things are right now, good or bad, so they don't really push for improvement. And finally, basic standards are old and pretty much out of date, only really used to spot long-term trends. Okay, so once you've set your standards, you can start using them to build some really powerful management tools. And one of the best is the flexible budget. It uses those standard costs we just talked about to give you a much clearer picture of how you're performing. Think about a traditional budget. It's usually fixed for one level of activity. Let's say you plan to sell 10,000 units. But what happens if you have a great month and sell 12,000? Well, comparing your actual results to that old fixed budget is kind of like comparing apples to oranges. It's just not a fair fight. A flexible budget solves this whole problem by adjusting the plan to match the actual level of activity, and that gives you a truly meaningful comparison. And the process is beautifully simple. First, you start with your original budget. Again, let's say it's for 10,000 units. At the end of the period, you see you actually produced and sold 12,000 units. Great. So, step 2, you flex the budget. You basically recalculate what your costs and revenues should have been for 12,000 units using your standard costs. Then, for the final step, you compare that new flexed budget to what really happened. Those differences are called variances, and they tell you exactly where you did better or worse than you planned. It's a fair and really insightful way to measure performance. Okay, it's time for the main event. We're going to dive into 2 of the most fundamental, traditional costing methods out there. I want you to think of this as a debate, really. A debate between 2 completely different ways of looking at cost. Absorption costing versus marginal costing. And you know what? The entire debate, the huge difference between them, boils down to one single question. What do you do with fixed production costs, like the rent for your factory? Absorption costing says that rent is part of making the product, so it absorbs a little piece of that cost into every single unit you make. Marginal costing, it takes a totally different approach. It says rent is a cost of the time period, not the product, so it writes the whole amount off immediately. And this one little change in philosophy, it has massive consequences. So let's zoom in on absorption costing first. Its main goal is to figure out the full production cost of a unit. That means it includes absolutely everything: the direct materials, the direct labor, and a slice of all the factory overheads, both the variable ones and the fixed ones, like rent. This is the method, by the way, that accounting standards require for valuing your inventory on the balance sheet. So what does this look like in the real world? Let's take a look at Saturn chocolates. Using absorption costing, you can see the Sky Bar and the Sun Bar both look profitable. But look at the Moon Egg. It's showing a loss of 8 cents for every single one they sell. Now, a manager looking at this might immediately think, we've got to stop making the Moon Egg. It's losing us money. But is that really the right decision? Let's see what the other method has to say. Now, let's look at those same chocolates, but this time through the lens of marginal costing. This method completely ignores those fixed costs at the product level. It only cares about the variable costs, the costs that change with each unit you make. And the key metric here isn't profit. It's something else, something called contribution. So what on earth is contribution? This quote explains it perfectly. You take your selling price, you subtract all the variable costs that went into making that one item, and whatever is left over, that's the contribution. Every single unit you sell contributes that amount of money towards paying off all the company's big fixed costs for the month. And once those are covered, everything after that is pure profit. And here's why contribution is such a powerful secret weapon for managers. It's stable. The profit per unit that you get from absorption costing can go up and down depending on how much you produce. But contribution per unit, it stays the same. If a product sells for $20 and its variable costs are $12, its contribution is always $8. This gives you a really clear, reliable number. You know that every single sale, without fail, brings in exactly $8 to help cover those fixed costs and start building profit. So we have these two different methods, and they give us two very different pictures of our products. So which one is right? The answer is they both are. They're just different tools for very different jobs. This table breaks it all down perfectly. Absorption costing is for looking outwards. It's what you have to use for your official external financial reports. But for looking inwards, for making internal decisions, it can actually be pretty misleading. That's where marginal costing becomes your best friend. It's your internal compass. It's simpler, it's clearer, and it shows you the direct cash impact of selling just one more unit. The only catch is, you can't use it for your official inventory valuation. So here is the crucial point. If you only remember one thing from our time together today, please let it be this sentence. Absorption costing is for reporting on the past. It's a tool for showing what has already happened. Marginal costing is for deciding the future. It's the tool you use to figure out what to do next. And that leaves us with one last thought to chew on. The next time you see a report and it tells you that one of your products is unprofitable, I want you to stop and ask yourself this question. Is the product really failing? Or could it be that the costing method you're using is just painting the wrong picture? Understanding that difference, well, that's what separates good managers from great ones.